Last week, the Federal Reserve in the United States cut rates by 25 basis points, the first cut in almost an entire year.
Federal Reserve just delivered a long-awaited quarter-point rate cut this week.
This is a move that many expect will send the price of stocks soaring and take crypto along with it. Others are concerned that this is actually just a signal that the US economy is in a really bad spot, and the need to lower rates in order to stimulate economy means that the cracks are actually beginning to show. Stick with me until the end here, because I'm going to break down what exactly is going on, why this interest rate cut is potentially a little bit bigger than it may seem on the surface, and exactly what I'm doing to prepare for what comes next. I'm Keith D, here to talk everything money and markets. Let's dive into it. Let's start with the facts. On September 17th, we had the Federal Open Market Committee, the FOMC, lower the federal funds target rate by 25 basis points. This ended a pause in lowering the federal funds rate target that has lasted since late 2024. Now, when the Federal Reserve Chairman Jerome Powell took the stand on the 17th, he went ahead and called this a risk management cut, stating that there's no real need for an abrupt policy change like we've seen over the past 5 years. Now, as he said this, he also admitted that there are some growing risks in the growth outlook for the United States, which means that the economy is not necessarily doing too hot. That's the headline. But the drama around all of this is not the actual cut itself. Instead, it's who was actually sitting in the room when this decision was made. Less than 24 hours before the FOMC released its decision about lowering the federal funds target rate, Stephen Miran, Trump's economic advisor, was actually confirmed to the Board of Governors at the Federal Reserve. The thing about this is not only has Miran been an advisor to Trump throughout his new term, but it turns out that he's also going to continue to serve in that role as well. Normally, Fed nominees would step away from their political roles in order to maintain independence between the White House and the Fed. And in this case, Miran did not. This is a clear break from what we've seen in the past. But let's break this down a little bit further. The Fed, and specifically the Federal Open Market Committee, is responsible for setting the short-term interest rates in the United States. This essentially helps to determine the level of investment that's coming into the economy. Short-term interest rates can have a direct impact on the economy by, for instance, if they are lowered, encouraging more borrowing and therefore more investment, which should lead to more growth. On the other side of that, raising interest rates can slow down the amount of borrowing that's happening, bring the economy to a halt, and prevent there from being an overheating of the economy in terms of inflation. Now, the FOMC comes together about every 6 weeks to make their decision on where they want to set the target for the federal funds rate, which is essentially that short-term interest rate that I'm talking about. The FOMC is actually made up of 12 different participants. 7 of them are actually members of the board of the Federal Reserve itself, and that includes the chairman of the Fed. The other 5 members of the FOMC are actually some of the governors of the regional Federal Reserve banks. Each member of the FOMC has an equal weighted vote on what happens with interest rates at each of these meetings that happen every 6 weeks. Now, with that understood, we have a president who has also been calling for lower interest rates his entire time in office. The goal here is to lower interest rates to increase borrowing and grow the economy so that we can start to work our way out of this extremely poor debt to GDP ratio that we have in the United States at the moment. The idea is to grow the GDP number, therefore decreasing the overall debt to GDP. And to do that, you might want to have lower interest rates to spur that kind of growth that would be necessary to make that happen. Now, ever since inauguration, the current president has essentially been very vocal about his feelings toward the current Fed chairman, Jerome Powell. He's been openly criticizing Jerome Powell ever since that inauguration. Now, as all of that has been going on August 1st, we actually had Adriana Kugler, one of the 7 members of the Board of Governors at the Federal Reserve, actually step down and resign from her position. There's been tons of speculation around why that happened, but for now, we will stay out of that. Fast forward a few weeks to August 25th, and we actually had the president go ahead and openly fire Lisa Cook, another one of the board members of the Federal Reserve. Since then, there has been a legal battle. that has been going on around whether or not the president of the United States is allowed to fire someone in that position, and we won't get into that either. What's important to understand is that before the FOMC decision on the 17th, it turned out that the Supreme Court actually said that Lisa Cook would still be able to vote in this most recent decision. Now, the thing to point out here is that when Adriana Kugler stepped down from her position, the president actually had an opportunity to appoint someone else to become a member of the Board of Governors. His pick happened to be his own economic advisor, Stephen Miran. Stephen Miran is a known author of the Mar-a-Lago Accords alongside the current Secretary of Treasury, Scott Bessent. The Mar-a-Lago Accords is a trade initiative that is supposed to weaken the US dollar and strengthen American manufacturing. All of this to say that it seems that the president is putting the pieces in place to be able to get lower interest rates in the near term. The thing to note here is that Stephen Miran was actually confirmed to his position as a member of the Board of Governors less than 24 hours before the FOMC decision that just took place. Now, in the short term, there's no telling whether or not this actually made an impact on the decision that was made, but for sure, moving forward, there are now pieces in place to make sure that rates can go down. Now, besides all of that drama, we also have a huge hoopla going on with the labor market in the United States. In August, as all of that was going on, we had the Bureau of Labor Statistics admit that the United States had added 900,000 jobs fewer than it had previously reported. That was the largest downward revision since 2009. This makes it also a lot easier to justify the idea of lowering interest rates in order to spur investment and growth in the economy. The thing that was so weird about this is that everyone already kind of felt it, right? More people working part-time, longer hours, and we saw tons of layoffs. So now it turns out that the numbers are actually matching the mood. The problem with all of this is that if we can't trust any of the data, right, the labor market data is just way off, then how do we price risk in the markets? This is where a lot of opportunity and a lot of danger reside. Right now, the US stock market is at all-time high. But with that, we have to keep in mind that the US dollar, or the DXY index, is actually down more than 10% on the year. On top of all of that, we have gold hitting new all-time highs, going on a historical run. This probably says that there's something that's not too great about what's happening in the global economy. And then we have crypto, with Bitcoin hanging out right around its all-time highs, Ethereum also going up for that number and potentially signaling that we're ready for an alt season. On top of that, we have the US government, including the legislative and executive branch, working together to try and get crypto legislation across the finish line before the end of the year. What investors are asking right now is, are we about to see the market continue to melt up? Or are we actually seeing that everything is about to turn around from here, and for instance in crypto, that the bull run is already over? Also in the crypto world, some are calling for a super cycle, saying that in reality, it doesn't even really matter what's happening on the macro backdrop because prices are going to go up and they're not going to have as big of those drops as we've seen in the past. What I'm personally preparing for is a continuation of the trend in higher prices for stocks and the potential for a massive blow off top in the cryptocurrency market, where I will be taking risk off the table. Inside my private mastermind, we're actually going over exactly how shifts in Fed policy like this will impact crypto, stocks, gold, and global markets in general. We're mapping out the market cycles, risk, and preparing for the generational opportunity that is coming from the macro landscape, and specifically also what's happening with crypto. If you're taking this seriously and want a seat at the table, then click the link in the description to go ahead and apply for that private mastermind now. I'm Keith D, here to talk about everything money and markets. If you enjoyed this at all, be sure to like and subscribe, and let me know in the comments. What do you think? Is this the beginning of a historic melt-up, or the calm before the mother of all crashes? Drop your take down below and be sure to subscribe. See you next time.